How's it going, YouTube? My name is Amos, and I'm going to go on record by saying this. The portfolio that we are about to take a look at together is the textbook example of someone trying to maximize their total returns while in the wealth accumulation phase of their working years. What I'm saying is if you're not eyeballing retirement in the next handful of years or so, and you want to make your portfolio grow as much as possible, then this portfolio is the one. You might want to pay attention. All that to say, welcome to video 2 in my Roast My Portfolio video series, where I break down real portfolios that you guys submitted to the channel. We'll evaluate and analyze the portfolio, and I'll share with you how I would optimize the portfolio going forward. And I think this one is definitely worth watching. You might learn a thing or two. So today, we're going to be taking a look at Jackie's portfolio as if it's an MBA case study. Now, Jackie is currently 35 years old. Jackie is a senior project manager for a huge construction company that manufactures data centers. And I'll say this right now, he's in the right line of business at the right time. And what you see on your screen right now is a screenshot of his actual portfolio and the holdings thereof. And the strategy that Jackie has is quite simple. He wants to accumulate safe and steady dividend compounders. But he also has a lot of exposure to index funds, and he does weekly covered calls and puts to create additional income. However, for the purposes of this video, we're going to be focusing on the 16 stocks that you see on your screen right there. And the portfolio's goal is to allow Jackie to retire early so that he can stop working so freaking hard. He puts in like 70, 80 hours a week every single week. He wants to retire early through his portfolio. That way he can spend more time with his hobbies and then open up a pho restaurant in San Jose, California. So that's what he's trying to retire towards. Because I think one of the wisest things that I've ever heard is don't retire away from something like your day job of like 20, 30 years. Instead, retire towards something. Because what I have seen is that when people are retired and they lose their sense of purpose and their schedule is just all over the place, they get really bored. They let themselves go. They start doing bad decisions and choices. But on the other hand, while in your retirement, if you devote yourself to a new mission, to spending more time with the family or your passion project or whatever it is, it'll give you a new sense of life. And just in case you're not taking a look at his portfolio's numbers, he's absolutely a whale. At the time of making this video, the 16 stocks, this portfolio right here, the valuation is $11.3 million, and it generates roughly $87,000 in dividends. I think that number might be slightly off a few $100s, but needless to say, around $87,000, and the overall dividend yield is 0.7%. Now, what makes all of this even more interesting is that if we include his ETFs, the portfolio's valuation would go up by another $1.7 million. And here's a fun fact, Jackie has 99% of his ETF holdings into SCHD. So the man is on the right track. All right, so we covered the portfolio's strategy, goals, and who Jackie is. And now let's take a closer look at his portfolio. I'm gonna go ahead and make this a little bit bigger so it's easier on the eyes. Right now it's 100%. Let's go to like 125. Is that a little better? Maybe 150? All right, friends and family, I think we are cooking 150%. So here are my takeaways and notes. Number one, I'm going to say it again. I think this is the definition of a dividend compounders with cheese type of portfolio. If this channel had a mascot, this portfolio might be it. And just like if you walk into a McDonald's, there's different menu items you can pick. This dividend compounders with cheese portfolio, I would argue, is maximizing share price appreciation in lieu of the income. And if you take a look at the holdings, top to bottom, every single one of these companies have a giant market cap. And I would argue are probably the best of the best in the S&P 500, which is otherwise known as the market. And the portfolio does skew a little heavy towards the tech sector, but it makes sense. I can see why Jackie likes the tech space because that's where most of the gains have been for the past 3 years. So he's putting his money where the gold and the rainbows have been. And it's funny to say, but Jackie's portfolio has its own magnificent 5 because the top 5 holdings make up about 50.9% of the portfolio's valuation. When we talk about Microsoft, he currently has 2,500 shares of it and is valued at $1.2 million. And he also has a crap ton of UnitedHealth shares, 3,500 shares of UnitedHealth. Valuation is also $1.2 million. And to round it out, he has about $1 million invested into both Amazon, ASML, and then of course, how could I forget, Google, 1.2 million, which kind of makes me chuckle because when I buy into a new stock or open up a position, I'm talking about maybe buying one. If I'm feeling it that day, maybe 5 shares. Jackie, on the other hand, is talking about, I'll just open up 1,000 shares that first day. All that to say there's levels to the game. You might think you're a big fish, and then you got Jackie swimming around in the ocean right next to you, right, with the biggest dong. And what's really interesting about this portfolio is from Salesforce to Broadcom to Nvidia to Taiwan semiconductor manufacturing, they all have a small dividend yield. And that's why even though the portfolio's overall dividend yield is 0.7%, because of the sheer size, 11.3 million, dude, $87,000 in dividends. Because when you think about a smaller portfolio, a 0.7% overall dividend yield would spit out like, what, 200, maybe 400 bucks. But for Jackie, it's still $87,000. Now, just for fun, imagine if the $11 million were invested towards BDCs and REITs with a 7% overall dividend yield. If he were to do that, then the dividend yield wouldn't be $87,000 anymore. It would be $791,000 a year in dividends. That would be absolutely bananas. So to increase it from 0.7% to 7%, absolutely a game changer. And now let's jump on over to the portfolio scorecard. How would I grade and assess his portfolio? The first category is the asset and strategy metric. In that, we want to find out, do the positions and the holdings make sense for their goal? And I think it's a no-brainer. It's obviously going to be an S. I think the portfolio is a good reflection of growth with a little bit of dividends sprinkled in there. And I guess it makes sense because Jackie is 35. He's not eyeballing retirement anytime soon, so he shouldn't be going all out into income ETFs. So for his situation and scenario, the fact that he's going into the biggest and the brightest companies in the S&P 500, it makes sense. Now, the second metric is the risk level. Is it high in risk or is it low in risk? Now, for Jackie's portfolio, correct me if I'm wrong, but I would label it as a 3.5 out of 10. So moderately safe, but slightly riskier than portfolio number 1 that we saw on the channel. And that's because Jackie's portfolio has a moderate amount of exposure to the AI movement, which tends to be a little volatile when things get a little cloudy or when particular leaders start to argue with one another on social media platforms. Stocks in that space do go on the sell-off. But I don't want to be a doomsday sayer because for the most part, almost every single stock in the portfolio is a household name that should move in line with the S&P 500 and the broad market. So if you're wondering which companies are at fault for making the risk level go up to a 3.5, I'm thinking about Nvidia. I'm thinking about the semiconductor chip manufacturing equipment company ASML. I'm thinking about TSM. I'm thinking about Broadcom. I mean, just case in point, do you remember at the end of last year going into the beginning of this year, do you remember the sell-off that happened in the semiconductor space because of the barriers issue? But I mean, in the grand scheme of things, they eventually did recover. And when we think about the quality of the holdings, do they have an economic moat? Are they sound? Are they amazing? Are they beautiful? And for that, for the portfolio, I would give an A. Dare I even say almost an A+, because nearly every single holding in the portfolio is fundamentally sound. They have above average financials and they have an economic moat and they're best in class at what they do. I mean, we could argue, is Lowe's better than Home Depot? Is Elevance Health Insurance better than UnitedHealth? But you get the point that I'm trying to make. I think the only one that I do not like at all, even though they're okay, but I just don't feel bullish about their future, is Deere & Co. And another one that I'm kind of ambivalent towards is Caterpillar, ticker symbol CAT. However, if I had to pick between the two, I would probably go with Caterpillar. The reason being is that with John Deere, they're in the business of making agricultural equipment and industrial machinery, which when you think about their gross sales, it tends to be cyclical. It's not every single day that a major corporation is going to buy 10,000 tractors. It has seasonality baked into their business model. However, I think in the past 10 years, John Deere made a pivot from just selling physical goods to now selling a subscription model of repairs and services in order to keep their machinery up and running. So I guess they adapted their business model to the 21st century. And then when it comes to Caterpillar, here's why I would pick them over John Deere. Their equipment, because they're also making industrial machinery, it's super crucial for the rare earth mining endeavors that's happening right now, which should put some wind in their sails. And the only reason why I know this is because I made a deep dive stock analysis for MP Materials. And for the last criteria metric, the dividend sustainability, do I see the dividends being cut anytime soon? Absolutely not. Even though I'm not the biggest fan of John Deere and Caterpillar, I do not see anybody on this list cutting their dividends except possibly Nvidia if they want to free up some cash to do more CapEx or to do R&D. But other than Nvidia, I think for the most part, their dividends should be safe. And even when I say Nvidia, I'm talking about the probability of them cutting their dividend is like a 0.01%. So overall, I will label it as a healthy. Take a good look at the portfolio scorecard, because now we're going to jump over to what adjustments would I make to optimize this portfolio? And I'm thinking about it in the lens of this being an assignment that someone else is going to grade. So I do need to make some changes. So as of right now, in terms of the valuation, when you add it up, 60% of Jackie's portfolio is allocated towards tech. However, if I had to make changes, even though I think this portfolio looks pretty coherent and sound, what I would do is reallocate some of that capital towards including the consumer staples and the REITs to a point where they make up about 20% of the portfolio with a combined dividend yield of about 5%. So about 20% of $11.3 million would be 0.20 right there. About $2.2 million invested into REITs and the consumer staples with an overall dividend yield of 5%. That would spit out $113,000 in dividends. So if we were to add $113,000 to the current $87,000 in dividends, then the new dividend payout total would be roughly $200,000. So I'm assuming if we were to just cut Amazon from the picture and potentially another big tech company, I guess this number would be closer to like 199,000, because if we take away another tech company that pays a dividend, then that would also get rid of their dividend payment. But the point still stands, roughly $200,000 in dividends. And the new overall portfolio's dividend yield would be 1.7%. So by introducing some of the more old school sectors into the portfolio, it would more than double the passive income from about $87,000 to $199,000. And it's probably enough to cover all of the overhead costs of a lifestyle that's not buying a new car every single week. You tell me right now, even though you have to pay taxes on the $199,000 in dividends paid out, don't you think that's more than enough to cover your bills, especially your mortgage, your car payments, your utilities and whatnot? $200,000. And I'm not talking about a 10, 15, or 20% dividend yield. We're cooking with a 1.7% dividend yield. So if I had to do changes and modifications, that's what I would potentially do. But in this case, I don't think Jackie needs that income right now. And that also raises the question of selling and creating a taxable event for his Amazon holding that would be a $363,000 profit. That's a lot of taxes paid for just that one single holding. But more importantly, if we want to introduce more income in the now, that would also sacrifice the portfolio growth. You can't have it all. So between you and me, I would just fail the assignment and tell the professor I wouldn't change the holdings. I would leave them as they are. However, in terms of the holdings, instead of giving the portfolio an extreme makeover and drastic plastic surgery, Because I think the portfolio is darn near perfect, well, I take that back. I would introduce a little more diversity and include some sectors that are not even represented, but I guess having 60% tech, 35 years old, it's okay. It's not ideal, but it makes sense. And I think the portfolio is proof in the pudding that it's working out for Jackie. So instead of changing things up, I'll just leave it as it is. And instead, I'm going to go ahead and give my grade letters for each of the holdings from S all the way down to F. Because remember, this is an MBA case study assignment that we're working on, right? So right off the bat, I'm personally not invested into Amazon, but if I were a betting man, which I'm not, I'm going to go ahead and make the assumption that in the next 2 to 4 years, I think Amazon is going to start paying a dividend. So with that in mind, I definitely think they're in the S tier. I think everything that they're involved in, from Amazon Prime's streaming to their e-commerce domination and AWS cloud, I'm really bullish about Amazon. So it's a clear S for me. ASML, an A. I can't put them into the S tier because the sales of semiconductor chip manufacturing equipment is not always going to be a steady road. There's going to be seasonality baked into them. I think right now they're seeing a lot of success, but I looked into ASML's financial history and my goodness, there's ups and downs. I think right now is the boom part of their cyclicality. And then when it comes to Broadcom, a company that holds so many different patents for all of the chips that are inside of our smartphones, laptops, and tablets, and now they're making customizable semiconductor chips for the AI data centers, this is a dividend compounder with cheese. I'm not invested into them, but I love this holding. And it gets better and better. We have another S in American Express. Love this one. And then we have our first B. And that might be a blemish and might be an eyesore, but to me, a B means the company is above average. But against his own portfolio holdings right here, he's definitely not an S or an A. Hear me out, and here's my argument. So we're gonna pull up Caterpillar's financials. And before we do that, I wanna show you their stock market performance. They're crushing it, okay? For the past 1 year, 31.38%. We do 5 years, we're talking about 206%, okay? However, if we jump on over to their income statement and take a look at their top line, okay? I'll show it to you visually depicted. It goes up, it goes down because the sales of industrial machinery is cyclical, friends and family. With that said, I would argue in 2023, they reached the peak of their cycle and now they're slowly in the decline. And you can tell by the objective numbers. It declined from 2023 to 2024. I'm looking at the top line, the revenue right here, to $67 billion down to $64 billion. And in the trailing 12 months, that's what TTM stands for, it went down by another 4.8%. And if we scroll on down to take a look at the profitability of the company, what you want to see for their earnings per share, the bottom line per share, is either a stabilized EPS where you can predictably tell that it's going to be at about $10 a share, or to be growing up into the right. Now, is that going to be the case with Caterpillar? Check this out. No, there's ups and downs, and back in 2016, they were unprofitable. They generated negative 11 cents of bottom line per share. That's pretty bad. They reached their peak in 2024, and now they're back on the decline. And it's the exact same situation with their free cash flow per share. I would argue up until 2023, it was growing at a very predictable and reliable rate. However, since 2023, it's dropping. So this is a company that had its boom, and now it's slowly falling down the roller coaster ride. And then with Salesforce, I would argue an A-. They're not in the S tier. They're going through a pickle right now because the growth of their numbers are slowing down objectively. But I want to show you this. So Caterpillar's numbers, you saw, it's up and down, it's inconsistent, and they're on the decline trend right now. If I pull up ticker symbol CRM, I just made a deep dive video for them. However, take a look at their top line. You tell me the difference. Is it growing consistently? Is it growing every single year? We should all be nodding our heads. Even if you're bald, you gotta be nodding your head, okay? And if we jump on over to their cash flow statement, the reason why I showed you the revenue is because the gross sales objectively tells you whether or not a company is growing. And if we take a look at their free cash flow, which is the cash left over after funding their operations, the actual cash, not the accounting manipulation of cooking the books, but the cash that's really going into their pockets. Right now, let's see, pull this up right here. Take a look at Salesforce's freaking free cash flow. This is absolutely spectacular. I mean, year over year, it seems kind of flat, but this trend, gotta give props where props are due. So Salesforce, I would argue their financials are head over shoulders better than Caterpillar, and that's why they're an A-. And the next one is Deere & Co. Very similar story to Caterpillar. If I just pull this up and I show you their top line, it's just like Caterpillar. It's a seasonality baked into them. There's highs and there's lows in their gross sales. This is not a company that is going to be consistently and reliably growing their revenue. So for me, that's a blemish and not something that I want to be involved with. However, I cannot deny it. Okay, their stock price history has been pretty good. Year to date, 10.8%, past 1 year, 17%, past 5 years, 111%. So it's kind of like Caterpillar, and that's why I picked Caterpillar above John Deere. Because they do almost the exact same thing, but I'm more bullish about Caterpillar's future and trajectory. Plus, they have a better stock market performance, almost double better, twice as good. And as we go down his list, there's a bunch of S's, and then there's UnitedHealth. Now, I have a third of my Roth IRA invested into UnitedHealth, and you would think I would give them an S, but that's not true. So even though their financials and fundamentals are kicking booty, they are really beaten up, and they're currently dealing with a lot of headwinds. So for that fact alone, it knocks them down from S to the A tier. And then for the past like 3 or 4 years, their performance in the stock market is negative. So I had to deduct some more points from them. Case in point, the past 365 days, UnitedHealth Group, negative 42%. But you take a look at their numbers and it's fundamentally sound. This company prints cash, high quality. I really like it. I'm not going to sell out of them. However, I'm not going to be delusional or try to pump my own stock by saying they're S tier. They're not. They're A-. And then to top it all off by putting the little cherry on top of this cheesecake, we're going to talk about Visa. Visa is an S. This is a company that I really, really love. As a matter of fact, I first invested into them back in 2019, and then I sold out of them at the end of 2024 in order to free up capital to buy into AMD. It sucks. I don't have a lot of money, right? So I have to sell positions in order to free up capital in order to acquire and buy into something else. And I think a natural question is, why don't you just buy and hold? Because if I feel like one of my positions and holdings have now reached their intrinsic valuation and my price target, for me, it seems like it's a good opportunity to sell. Capitalize on those gains so that it's not paper anymore, but to capitalize on it. And now I have cash coming back into my brokerage account, and I can utilize that cash to buy into something else that I think would yield higher results in the next 5 to 10 years. All that to say, I used the cash from selling Visa to buy into AMD and Nvidia, and then I sold out of both AMD and Nvidia after I got a 40 and a 50% gain in about 6 months. So that's what I do. I wash, lather, rinse, and I repeat that cycle again and again. Like if I had Jackie's portfolio, $11 million, I don't need to be doing all of that craziness. But for me, I don't know if you can relate to me on this, because my portfolio is a fraction of his, I do need to sell to use that money to buy into something else and to keep compounding the portfolio. So what do you think of Jackie's $11.3 million dividend portfolio? What constructive criticism would you give? Because I might have missed something. I think I got all of the main points, but just in case, leave it down below in the comments section. Do you feel like it's not paying enough income? I don't know, right? And if you're still watching the video, I wanted to make a response to this comment because I understand where they're coming from. The whole idea of hiding the actual numbers and the dollar signs and only showing the percentage change so that I don't make other viewers overwhelmed or, in his words, intimidated. So here's my answer to this. I completely understand where he's coming from because for the longest time, I used to be that way as well, right? When I started my investing journey back in 2019, whenever I saw a portfolio that was like this big while mine was only this big, dude, I felt like a small person. I was envious. I was jealous. I had negative emotions like, dude, why the heck is he so rich? Why am I so poor? And then one day I changed my mentality and my outlook and perspective, and that's what I want to share, right? The reason why I show the full numbers of a portfolio if someone submits to the channel, it's not to create insecurity among the investors and the viewers, but because I want to show the genuine, the objective truth and the factual results. If I blur stuff out, then we're not really seeing the true results of someone's hard work, because this portfolio is a manifestation of his hard-earned money going to work for him in the stock market. We truly don't know how hard Jackie had to work in order to raise that money to buy into all of those stocks. We only see the end result, and we might judge him for that, but I think that's wrong. So, my goal through this Roast My Portfolio series is to turn the numbers that you see on the screen into motivation and inspiration for anyone that's watching, to show like, dude, it's possible for you, it's possible for that person, it's even possible for me. But I also think it's really important to remember that every single one of us, we're on a different timeline and chapter in our journey. Not all of us are in the exact same place. You might be the same age, you might be the same ethnicity, you might even have the same height. I'm 5'2", sometimes 5'3". But jokes aside, I say that because if you're currently on chapter 5 in your book of life, in your journey, and you're comparing yourself to someone else while they're on chapter 15, that's not a fair comparison. I think a really good metaphor is someone that's a yellow belt in Brazilian Jiu-Jitsu comparing themselves to a brown belt. Dude, to get to that brown belt, he's been on the mats for like 5 years, whereas you might have been doing BJJ for like a year at most. So I hate to be that guy, but I encourage anyone that's feeling upset or bitterness towards Jackie and his portfolio because it's bigger to just take a tactical timeout. Dude, seriously, drink some water, take a deep breath, and hear me out. I think that we should get to a point where instead of feeling these negative emotions when we see someone doing better than us, quote unquote, but instead to congratulate them, to celebrate their win and their victory. Because I would argue when someone else is achieving their goal in life and their dream, dude, that's a good thing. We should be clapping our hands and saying, dude, hard work paid off, good job. Instead of saying, you suck, you're a trust fund baby, you're rich, I'm poor. We can confine ourselves to that negativity, but dude, that's just not mentally healthy for you. Because think about it like this. If your reaction and response to success is negativity, then eventually negativity is going to be your goal. You're not going to be able to attain success because that negativity just weighs you down. Does that make sense? And I'm not going to leave you on that note, because think about it like this. Imagine how you're going to feel the day that you do eventually reach your goal, your dream, or your prized portfolio valuation. I mean, you might be short of it, but you'll still be way ahead of others. Like say you wanted, I don't know, like a $2 million portfolio, but eventually when you do tap out, it's only like 1.6 million. Dude, it's still 1.6 million. So all I'm trying to say is one day you'll get there as well. You'll be on chapter 15 eventually. You might be on chapter 1, you might be on chapter 10, but with enough time, dedication, consistency, and just believing in the stock market that dividend growth investing will do the heavy lifting for you, you will get there. The slow and steady will win the race. Now, if you're out here trying to YOLO and gamble and trying to get 5,000% gains with day trading, might not happen. Because just as quickly as you go up, it can come tumbling down, crash, and burn as well. So the slow and steady, the tried and true dividend growth investing into dividend compounders with cheese is the way that I'm choosing to go. It's not financial advice, but I genuinely hope that we can get to a place where instead of tearing each other down, we can lift each other up and say, damn, dude, good job. That's all I want, all right? Hopefully this resonated with someone out there. Otherwise, I just went on a crazy rant for no reason. Anyways, if you made it to this point in the video, then I love you. Stay safe, good luck in the stock market, and I will talk to you next time. Peace.